let's talk specifically about what you think we have learned, should have learned about the economy, how we manage the economy from this tumultuous time we've had with the pandemic and the post-pandemic effects.
Thank you, David. It's great to be back. The chairman yesterday took advantage of the longer format with you to lay out sort of a more holistic view of monetary policy rather than to, make news about the next meeting. And when you asked him about the longer run lessons, he pointed out that the global economy faces a wide range of risks. And COVID really came out of the broader range than we usually see. And importantly, the experience with COVID wasn't really present in the standard historical data that we use to do quantitative analysis or from which policymakers have formed their economic intuition or their heuristics. And so now looking back and seeing how COVID affected the economy and how it's showing up in the data, there were supply shocks, there were reallocation shocks, which just have not been a historical regularity in the data. And so, economists and policymakers are very reluctant to say this time is different. It seems opportunistic, and Reinhardt and Rogoff have a famous book with that title, which was meant with irony. But what the chairman was pointing out is something that economists have been thinking about for quite a while, is what was different about COVID and how does that bear on policy? And in particular, things like the supply shocks and the reallocation shocks allowed a confluence of both tighter monetary policy, rising rates, lowering inflation, and at the same time, a robust labor market. So you wouldn't want to have relied on that going into the hiking cycle, but it's turned out to be a really important characteristic and is going to affect policy going forward. Yeah. So I think there was a recognition, an acknowledgement of how different the COVID shock was and how it's affected policy, and a willingness to think outside the set of issues that were really foremost during the last 2 decades, which was low inflation, low rates, zero lower bound.
Well, and a couple of other aspects that may be somewhat different from 2019 are, number one, geopolitical risk, which has really popped up, which does have economic effects, obviously, as we increase defense spending, not just in the United States, but around the world. Climate has always been there, but it's getting more and more imminent. There's got a lot of investment that has to be done. And also there are some ramifications of, I won't call it deglobalization, but maybe more regionalization, not quite as globalized as before. Does that indicate that, in fact, the paradigm is shifting toward a higher rate environment?
There's a deep discussion now about what our star is, what the neutral long-run real rate of interest will be. And I think there's been a tendency to think that it's a bit higher, that we're moving away from the sort of secular stagnation concept or model that kept rates very low for a long time, and into a riskier, potentially higher investment environment, which would be consistent with a higher rate of interest. But most of the actual numbers people are putting forward show, pretty small adjustments to that, because the low productivity aspect of secular stagnation is still a real concern. So we have these competing, models. Nobody wants to jump in and say, well, this time really is different, because the evidence isn't that strong now.